Liquidity is very important in commercial real estate because you never know when the time might come when you have to sell. It's good to have an idea of how liquid it is, because commercial property is different from other assets, for example, shares or bonds, which could be sold very quickly. So when you're buying a commercial property and developing a investment plan for your commercial property with your commercial real estate coach, consultant, you must ensure that you consider all the situations. When the time comes to sell, there are various factors affecting liquidity in commercial real estate: the property type and size. For example, a small retail space versus a large industrial complex. The lower priced small retail place has more potential buyers for it. A very large industrial place, for that matter, a shopping centre, for example. There's only a handful of people that can afford to spend $100, $200, $300 million to buy a shopping centre, whereas there are more buyers for that $1 million single shop. Location and conditions. For example, a CBD property versus suburban property. Now, sometimes the city one is in high demand, the suburban one, or it may be a great suburban area. There's high demand there, easy to sell. You've got to work. Things change all the time. The economic cycle and market trends. For example, during the financial crisis of 2008, 2009, commercial property liquidity was difficult. If you wanted to sell, you had to discount your property and sometimes sell at a loss. You don't know when it will happen. The economy changes all the time. Are you ready for it? The condition of the property. In condition, where it encouraged more buyers, more attractive for buyers to pay a high premium. Or is it run down, needs a lot of work? My experience over the years, I found that people don't like to buy problem buildings. Even though I believe just about every problem in a building can be solved. People, percentage. If the building's worth $2 million and needs $1 of repairs, it's $1 million plus $1 million repairs to buy. You won't sell it for $1. In that situation, you'd be like to sell $800,000 because people factor big money, overestimate what the cost is to a certain standard. In most cases, not all, but most cases in my experience, a single multi-tenanted building. Now, it's debatable too. Some ways it's easier to have one tenant, but if you lose that tenant, you've got to find a new one. Whereas you had 6 tenants in the building, you lose one, it's only a small percentage. So replace it with another one. So you've still 5, 6 of the income coming in. So that's an important factor. Of course, if you're selling a vacant building, people understand that it takes time to find a good tenant to pay the rent. Trouble getting loans. The bank's aware of these situations as well too. That has to be factored in. Finance and debt structures. For example, encumbered property versus one with complex financial arrangements. So where you've got liquid, you can sell straight away. For the situation, we've got loans and all these financial agreements with partnerships and different banks and that sort of thing. It becomes very complex. So that has to be taken into account. Also take into account the typical holding periods for commercial real estate. Some properties, accommodation type properties like boarding houses, that sort of thing, may have a shorter turnover period, whereas large properties, larger hotels, major shopping centres turn less often. There are various factors influencing holding periods. The investment strategy. Is it are you looking for a short-term gain, value added, optimistic? Are you taking advantage of a market cycle, say buying waiting to sell it, market picks up, buying gloom, selling boom situation, which smart investors adopt. Tax consideration where capital gains tax, depreciation to pick up. All these things are taken into account on liquidity. So you may want to sell. You may have large capital gain, which are tax expenses you can't write off anywhere else. So that has to be considered. On the other hand, if you can write it off, maybe more liquid for you. You take a little bit of a loss, but overall you get a gain because the tax advantages you may have. Talk to accountant, discuss these situations. There are various strategies for enhancing liquidity. For example, the most obvious one is property improvements and renovations, or total redevelopment for that matter. Creating building systems to attract high-quality tenants, paying tenants. You may diversify within your portfolio. For example, mixing property types and locations to reduce overall portfolio risk. Some areas may be ready for other declining. Most areas you're not sure of, or so you spread your eggs a bit maybe. That might help you with liquidity, so you can sell one area property somewhere else. Structuring favourable lease terms. Now, this is what we mean by more lease terms. For example, if you property which is in condition, or the scratch, say 6 tenants, you may want to stagger your leases so that will expire at the same time. That could be a thing. On the other hand, the property is in need of refurbishment down the track, or maybe in the process of being rezoned, opportunity might come to redevelop the site. Need to talk with your commercial property coach to structure your leases so that there is an end date. They will finish in 2, 3, 4 years' time. At the time, the opportunity to knock it down and do whatever. Thing means maintaining relationships with potential buyers, institutional investors who may want to put it in a portfolio. So when the time comes, it's easy to sell. There is utilizing technology when you want to sell it. Liquidity considerations for different commercial property types. For example, the obvious one, recent one, pandemic with office properties. The impact of from home trends to office liquidity. Office buildings are harder to sell. Another example could be retail properties. E-commerce has meant that less people are going to the shops and buying online. Things in growth of industrial properties. People are buying online. These storage facilities, they've increased in value over the last few years. So they become in high demand and it's reflected in the prices they're charging to buy them. So they're easy to sell now. Whether that stays, we don't know. Accommodation like boarding houses, lodging houses, that sort of thing, they've become high demand because people are living in smaller households, 2-person. This is the family homes, migration, divorces, separations, all these factors come into it. So the accommodation of industry is in high demand. Things like hotels. Tourism wasn't going so well a few years ago. Pandemic, it's coming. Tourism are coming. They're coming to the country. There's a growing demand for hotels. They become more favourable investments. They are. Tourism declines, out to sell. So these factors have to be taken into account. It's a role of market participants in liquidity. For example, institutional investors, pension funds, scale property transactions. I found over the years, most funds work in $100 million bundles. So they may want to purchase 10 $10 million properties or 5 $20 million properties. Believe it, fewer and fewer of those properties are. So when they do come, they use this that money because they've got to spend the money, invest that money for the funds. And so it's well maintained, getting an income, easily slot into their funds portfolio. Private equity firms buy domestic buyers during downturn for opportunities. Maybe it's getting a little bit of rent, possible future site into their line of what they're foreign investors. They might look into the country. Their country doing so well, their currency is all over the place. They want something more stable. They might decide to your country. It's always boils down to supply and demand, liquidity situation. You may have for example, a boarding house or an industrial place with several tenants in there in a good location, easy to sell. And if your property country town or a regional centre, which is going for a decline, more difficult to sell. Harder to find tenants. The buyers are aware, and they tend to be discouraged that more built-up areas which have got continuous supply of new people coming in and a higher chance of releasing again becomes vacant. Instead of income, it's also easy to get loans from the banks. Liquidity changes over time. Various areas improve, some areas decline. You've got economy situations, you've got changes of buying habits, as we mentioned before, the pandemic and how office demand was declining. It's maybe coming back now. We don't know. Industrial wasn't very hot 5-6 years ago. Now it's of the month. Will that keep going? We don't know. Retail softened a bit. It's improving all the time. The retail shops seem to be getting smaller because of online, combining online and offline sales. People are coming back to the shops. So whether that continues as well too, I think that most people enjoy the experience of going out and buying something they can touch and feel. That never certainly has declined a bit. To what extent? Again, we're not sure. So in conclusion, you have to balance liquidity and investment objectives. It's important that you conduct a thorough due diligence, work with your commercial property coach, and do a market analysis. What's happening in the market? Are there changes in the area? What's improving? What's declining? Are there any policies which will improve things, or council changes, rezonings? All these things come into effect. Interest rate, financial situation. Is it hard or easy to get loans? So do your homework, work with your commercial real estate coach, accountant, your lawyer, to ensure that you're getting the best possible deal. And you build towards a situation where property becomes, just in case, the fact is at some stage to sell. It's better to do it on your terms, people's terms. Planning is essential. What are your comments? How are you planning your commercial investment? And subscribe to this channel for more videos like this. Tastzidis from CC Properties.